Welcome to TheoTrade. This is Don Kaufman. It's October 27th, 2018, and you are watching the TheoTrade Weekend Update. All right, well, where to begin? Another yet wild week of volatility inside of the broader marketplace. Now, on this video this weekend, I really want us to focus on a couple of very major points. I don't want to hear statistics, and I'm the quantitative trader here. I don't want to hear statistics. I don't want to hear that, oh, it's the worst month since, 2009. Put it all aside. Seriously, brush it aside right now. Focus on a couple of main points. Here they are. Number one, we're going to be talking about the efficiency trade, or what I kind of call monkeys and levels. I'll explain that here momentarily. Number two, we're going to talk briefly about the Fed. How is the Fed going to react to all of this? Is this putting pressure on the Fed, okay, to what? Well, let's slow down. Let's slow down with interest rates. We'll come to that here momentarily. And last but not least, kind of a daunting task is to look at how stock buybacks are influencing all of this. Now, let's get right to it here, and then we're actually going to bring this up in terms of, well, some of the charts. First of all, when I talk about the efficiency trade, this to me is the single most important kind of factor and feature inside of the marketplace right here, right now. The efficiency trade. First and foremost, when I talk about efficiency in the marketplace, right, as we're trading throughout the course of this past week, we saw some fairly wild trade, but it was still, on a relative basis, rather efficient. We didn't see incredible volatility spikes, did we? I mean, did you see the VIX flying into the 30 handle, the mid 30 handle, the 40 handle? Absolutely not. The VIX, again, kind of stared the market right in the face, and volatility, this is nothing. I've seen this move before, and that's because it did see this move before, back in February. Clearly, though, this is a lot more serious. When I talk about the efficiency trade, there's one real key point that I want to make. Okay? Throughout the course of the last few weeks, and actually last few months, I have been talking about very specific levels inside of this marketplace, what we actually term gravity points. Now, for those of you, if you've tuned into any videos that we've done, literally in the last couple of weeks, all I'm talking about is, we're going to ping back and forth in these gravity points, from 27.31, and we'll cruise down to 26.82, and below that we have 26.26. Well, if this marketplace is getting wild and if it's getting unprecedented, how can a monkey like me be picking out the levels? The bottom line is, because it's not. It's a rather efficient marketplace. That does not bode well moving forward. And I got to stress that time and again when I say that doesn't bode well moving forward. If we're still capable of picking out levels, and bear with me here because on Friday, all right, yesterday's trade, again, wild sell side activity, yet we missed the 26.26 level inside of the S&Ps by 1 point. How is that possible? Because it's an incredibly efficient market. You want to see efficiency break down. That's what people talk about, like we're looking for a bottom. You're going to bottom fish right now? I'm not bottom fishing anything. Okay? In fact, when you look at this, you have to recognize there could be another serious leg of volatility that has not kind of, reared its ugly head just yet. And you better think about that. Again, I'll show you more in just a minute when we get to the chart about this efficiency trade. Next, the Fed. Everybody's focusing on the Fed. What are they going to do in December? Okay? The probabilities of the Fed hiking in December have now diminished a little bit. That shouldn't even be in focus right now. It doesn't have to do with the hikes. Okay, it doesn't have to do with interest rate hikes. It has to do with the fact that they're contracting the balance sheet. Again, I'll show you that here in a moment. Last but definitely not least, that we've got to focus on stock buybacks. Stock buybacks have actually created an artificial bid in this marketplace. What does that effectively mean? They've been buyers, constant buyers. They're never sellers, they're just buyers. What do? They're buying back their own stock. So are the stock buybacks, are they going to continue? Are they going to kind of peter out in a rising interest rate environment? Because if they are, again, that artificial bid under the marketplace is gone. And you have to recognize that in all this volatility that we're seeing in the last couple of weeks, the stock buybacks, they have been going on. They're ongoing. Apple's sitting there, well, we're still buying back stock. Okay? Yes, they're still buying back stock, and yet the market is still falling. It tells you, again, there's real sell-side activity. At what point, though, are the stock buybacks, again, going to start to relinquish? with that, we're going to get into some really detailed specifics here. I'm also going to show you a couple of trades. Stay tuned. Let's get to the charts. To the charts we go. Let's jump right into it here on the SPX. The SPX, of course, what I deem here at TheoTrade as the mother of all products. The SPX, along with the E-mini S&P futures. People, that drives order flow in the marketplace. Now, as I was mentioning on the video portion, a little bit about what we term the efficiency trade. Okay, the efficiency trade wraps around a number of different concepts. One of them, though, being expected move. Now, what is expected move? Well, these little hash marks, okay, represent the expected move on a week-to-week basis, so a 1 week basis. That central point, that's kind of where the week started. The upper edge, the lower edge, that's actually the expected move. And again, well, what is the expected move? It's how the option markets denote risk moving forward. So let's give you kind of a quick example and then jump right into why this is so important and why I call this the efficiency trade. First of all, this very last week of trade, we are expecting a $66 move. Now, that's $66 higher or $66 lower. Did we breach the expected move? And the answer is we did. We actually did. We breached the bottom of the expected move. We should have, okay, held inside of right around 27.02. That was the lower edge. Okay, where did we end up? Right here at 26.58. So we breached the bottom of the expected move, which is actually, it's one sign, okay, of the markets becoming less efficient. But this is not, if you're into options, this is not a sign that you want to see. Okay, and you're like, well, what do you mean? Well, first of all, we breached the expected move last week. Okay, we breached it the previous week. So what that's actually telling you, and again, huge amount can be deciphered from just looking at these expected moves. And then I'm going to move on to the S&Ps, which I think are even more important at this time. But a huge amount can be kind of discerned from just looking at the SPX and these expected moves. And I got to really drive this point home to you. This is going to be kind of a complex thought. Okay, in markets, you have two types of volatility. Okay, there are two types of vol. There's historical vol. Okay. And there's implied vol. And historical vol, what is historical vol? It's the actual movement of the market itself. Then we have implied volatility. Implied volatility, well, you know, these expected moves are a type of implied volatility. And the bottom line right now when it comes to volatility in the marketplace is that historic volatility, which is actual price movement in the SPX, is still exceeding implied movement. That it's not that good for option premium sellers. I've started to sell some premium. I've started to sell some premium, but I'm not exactly like, you know, unloading the boat into it. And I got to drive this home. This is what I'm talking about with this efficiency trade. If you can't, you know, listen, if you can't read into this, that's why I'm bringing it up. All right. Lots of people are going to go out and they're going to be like, yeah, the volatility is rocking. And they're going to start selling options premium. Okay. It's not wrong right now to start selling options premium, but you got to do it with a very soft hands, what I call alligator arms, right? You don't want to go out, you don't want to load big positions into premium selling when, again, I got to stress this, the actual market movement is still exceeding, okay, what the options market is depicting risk to be. And now that might be true the previous 2 weeks. Now this next week, moving forward, okay, moving forward, and again, here we're actually going to cruise over to the options chain itself because I think it, it's important that you know this. It's a $90 expected move. Now, cruise back over to the chart. So in the previous week, okay, in this previous week right here, we had about a $66 expected move higher or lower. Now we're sitting just shy of about a $90 expected move. So what the market's actually telling you is there's still going to be ample volatility this next week. Okay, ample volatility this next week. But, all right, now you're going to get paid what? $90 for selling premium versus, for example, $66. And that means like if you sold like an at the money straddle, things are going to be trading for almost $90, which seems crazy, but the market's actually preparing you to take more risk. So why do I say though that the market is still quote unquote too efficient? And the one thing I got to reiterate this, if you're selling options premium, you might be selling yourself off into an oblivion. So a lot of people will look at the bottom of the screen over here and they cruise over to option statistics and the IV percentiles and so forth, and they get themselves all hyped up that, again, this is it. Volatility is jacked up. Okay. But I want you for just a second, just bear with me here. Just take a quick glance, okay, on the right-hand side of your screen. This is far more important. At TheoTrade, I'll talk about individual stocks that I'm long or short, and I'll talk about positioning myself. Okay. This is far more important. There is a big issue right now in markets. Do you realize that if you look like 30 days out, and 30 days out, it's roughly like what the VIX is, okay? The implied volatility is like 23%. You might not know what 23% is, but for the most part, I look at that 23%. The S&Ps right now, they're laughing. They're laughing. Implied volatility, it's not jacked up, okay? It's not even that high. I mean, when you get 30-day options that start getting to 30, 35% out here in the SPX, then risk is getting a little bit more serious. But at this point in time, this marketplace is laughing in your face, and you better listen to it. Because I'm telling you right now, the implied volatility can go a heck of a lot higher. So point one, that is, and by the way, when I say that the implied volatility can go higher, it's more of an opinion, okay? Than it is anything. And I would expect it to go higher right now. But let me add some more concrete evidence to this. And I think this will make you a little bit nervous about running out and the types of trades that you should be taking. Okay. Again, I'm telling you, if you're going to sell premium, be rather constrained that the actual moves in the market are still exceeding the implied volatility. That's a big, big portion. I know, again, a lot of people will point to the VIX at the 24 level. The VIX at the 24 level is only on the edge of it's not even really the edge of one standard deviation outside the norm. Okay. It has to get into the mid 30s to actually hit what we call 2 deviation territory. So that's why I think it's funny when everybody's mentioning it's the worst month since 2009. Yeah. Well, how come volatility is laughing in our face? Think about that for a second. There's almost like a suppression trade to volatility, and that volatility, it needs to absolutely erupt. Let me give you more evidence on this, okay? The one thing, and it really, it bothers me. So I do a huge amount of regression analysis to be able to decipher what we term these gravity points. And again, this is still all about the efficiency of the markets. Huge amount of work basically to come up with these gravity points. And the gravity points, if you haven't looked at them recently, here, let me actually knock you down to this is a 30-day 1 hour. If you haven't looked at the gravity points, okay, they're totally in play. I'm telling you, all we're going to do is we're going to ping level, we're going to ping level, we're going to ping level, okay? We got down, and I want to show this on an intraday basis, okay? If the markets are so unprecedented in terms of volatility, if it's so horrific, then how can a monkey pick out, all right, within 1 point? By the way, I didn't pick this out yesterday. I picked this out months ago. We're talking back into, and again, if you want to pull this up in the chart, all right, we were talking, that's all the way back to March. No. Let's go further. Go further back. And I'm telling you, this makes all the difference, people. Okay. Oh, here we go. The 26 level. That was the first day, and it was all the way back, okay, into, again, the March timeframe when that level was actually deciphered. Some of the other levels, all right, and I've actually got the start date. Some of the other levels actually go back all the way into, again, all the way into the time frame of January and February. So these gravity points, again, painstaking, okay, to actually find them. They're not based on an indicator or a study. They're actually based on order flow in the marketplace. But again, I will reiterate, if the market is wildly, okay, and out of control, how can we actually pick out? And I poke fun at myself and say, a monkey, but hey, listen, if I'm able to pick out levels in the marketplace, it can't possibly be, okay, a wild or unprecedented move. And that should resonate with you big time, okay? I need to look at this marketplace and I need to look at these gravity points and go, this is totally out of control. Clearly it's not. Clearly the market's not out of control. Clearly we're just pinging levels. And again, these levels are major trading firms, and where that trading firm actually has concentric amounts of risk. So that's why we stop and, at 26. Again, within 1 point, okay, within 1 point, we hit that gravity point, and that thing has been around now for months. So enough of the efficiency trade discussion right now. Clearly, my stance on this, and my stance is a very simple one, and I'll sum it up, okay? if you think this is volatility, the marketplace right now is saying you ain't seen anything yet. That doesn't mean that this next week is going to be wildly volatile. It simply means moving forward, keep your helmet on. Okay? Keep the helmet on. The next thing I want to talk about, the Fed. I've got to talk about the Fed briefly. Why? It's important. It's very, very important. Everybody keeps, they're going to continue to raise interest rates. And of course, the administration is putting some pressure back on Jerome Powell about the rise of rates. It's not about the rise of rates. Okay? We're getting all twisted up and misconstrued in there. It's about the contraction of the balance sheet. The balance sheet. What does the balance sheet look like? Okay? Here we go. That's what the balance sheet happens to look like right now. They're contracting the balance sheet. But net, here's the full picture of the balance sheet. And again, I don't mind. I'm drawing on the Fed. By the way, this is just the Federal Reserve, website. Here's the balance sheet. And I showed this the other day on a video. And it's look at that. We're just descending a little bit. That's $4 trillion. It was up to about 4.5 trillion. They're just starting to descend. And that doesn't necessarily bode well because, again, the descension of the portfolio has yet to really kick into high gear. But if you do look at it on 6 months, that's kind of a wild chart. But if you believe that the entire marketplace might be a Fed-fueled bubble, then you better look at this balance sheet very, very carefully because the S&Ps have already come off, okay? 10% pretty much from their highs, and the balance sheet has barely been contracted. Again, doesn't exactly bode well for the marketplace. I wish I could find some positive, news out there because right now we're looking at markets that are too efficient, okay? Number two, the Fed balance sheet. Listen, they may stop raising interest rates due to pressure from the administration, but they're not going to stop contracting the balance sheet. They have to. Why? Because what happens if the economy, was to drop back into a recession, let's say 2 years from now? The Fed is left without any bullets whatsoever, and that's a scary proposition. Last but not least, stock buybacks. For that, we'll bring up companies like Apple, okay? There's a lot of fundamental analysis that goes on in a marketplace, and that fundamental analysis, seeks to try to figure out what these companies should really be valued for. But the one thing I don't really hear a lot of them talking about is how do stock buybacks factor into that? If there's a constant bid under this marketplace being created, for instance, by Apple, how do the fundamentals factor into that? And more importantly, at this point, you should think to yourself, when are stock buybacks going to cease? I'll tell you. As soon as any of the companies in the S&P 500 that are doing stock buybacks, if they view the future as just the slightest bit more grim, they have to halt the stock buybacks because you got to start to tuck cash into the coffers. Put the cash in the mattresses because we're going in, and that's when they're actually going to halt the stock buybacks. Bottom line, again, this is a little bit of an opinion piece. 2018 was the largest in stock buybacks in the history of the marketplace by far, right? This is it. That was the absolute top. I'm calling a top for stock buybacks. I think you're actually going to hear, in, for instance, the first quarter, they're not going to be doing stock buybacks nearly as much. Maybe Apple, they got a lot of cash, but again, it's going to diminish. And you have to recognize that right now, by the way, Apple unscathed throughout the entire marketplace. Google, a lot of these companies are doing these monstrosity stock buybacks, and they've been buying back stock, and yet what? The companies are still ultimately falling. But with that point, I still want to make the relative point. Microsoft, they had their earnings this week. Come on, people, they're still stones throw off the all-time high. Apple unscathed in this entire event. Granted, Apple has earnings coming up. You have to look at this and you're all right. Amazon starting to feel a little bit of pain. But any time that you think that the tech companies have felt a little pain, all I want you to do is open up at least a 3-year chart. Open up a 3-year chart and be like, oh no. I mean, these are underlyings that could easily crest back to 1,200, for instance, 1,000. And you'll recognize, again, how wild this move to the upside really was. And the bottom line with all of this, whether it's, stock buybacks, whether it's what I call the efficiency trade, whether we're talking about the Fed, we're just going in right now. And that's when I say, listen, next week is going to hold, again, some wild volatility. I wouldn't call it necessarily unprecedented, but next week is absolutely going to hold some wild volatility. We're going to get some great trading opportunities. But net, if you're wondering what this marketplace is going to look like, 3 months from now, 6 months from now. Stock buybacks, they already hit their all-time high. The Fed is going to contract the balance sheet, okay? Those are two major factors that are going to have constant influence to the downside on this marketplace. Now, throw the psychology in there. You just saw, okay? You just saw the marketplace go through some fairly ugly times. And if you looked at the spiders, for example, for the last 10 years, and a lot of people will, this is your 401k. It just took a little chunk off the top of the 401k. There's a lot of people, mom and pop, sitting home over this weekend that are going to say, you know what? I've had enough. And we could have, again, some wild movement. And that's actually what you want to see. You need to feel the fear. If you don't know what that means, well, I think you're going to find out here in the very near term. I want to thank everybody for tuning into the weekend video. Join us all throughout the course of the week here at TheoTrade because, again, in a more volatile marketplace, constant trade setups, we are going to be looking at a different underlyings, both long, short, a little bit of selling premium, actually a little bit of buying premium. But net, we got to cover these major concepts on this weekend update. This is what matters most moving forward. Have a great weekend, everybody. Bye-bye.